Have you been hearing the buzz that everyone is talking about when it comes to life insurance? The fact that you can borrow money out of your life insurance policy while you are alive. Now, it's true, but back in the day, life insurance was actually pretty simple. People would just buy it to protect their family in case of their untimely death. But over the years, life insurance evolved, and wealthy people discovered that it could be used for something far greater. It was a great place to build tax-free wealth long term. Permanent life insurance always had this cash value component to it that was originally created just to sustain the death benefit. But wealthy individuals uncovered that they could actually borrow against this cash value component to access the money inside, all tax-free. This is where things got interesting, and the idea got picked up by some relatively pretty clever thieves, and permanent life insurance became one of the go-to places for money laundering, because permanent life insurance wasn't regulated like a traditional investment vehicle. There were no laws governing how much money could be stuffed inside of life insurance relative to the amount of death benefit that was actually purchased. Even to this day, somewhere between $80 to $100 billion is laundered annually through life insurance. This is why life insurance agents are required to take anti-money laundering courses every single year. Now, eventually, the government and the IRS caught on, so of course they had to step in and regulate it. So in this video, we're going to dive into how life insurance evolved from just this simple death benefit to this powerful financial tool and strategy that we know today to build wealth tax-free. And we're going to talk about all the laws that were created to keep it all in check. As the practice of building wealth inside of life insurance grew, the government began to question whether life insurance was being used for its original intent. I mean, was this still truly life insurance, or were they using life insurance as an investment vehicle? This led to a key turning point in the industry and eventually the development of Section 7702. Section 7702 was introduced to ensure that life insurance policies met certain criteria to basically be considered legitimate life insurance policies, and also to ensure that people weren't turning them in to some tax advantage investment vehicle without any regulation. Basically, the government wanted to ensure that the purchase of these policies was for its original intent, which was to provide a death benefit to your family upon your passing. So how does Section 7702 work? Well, in order to meet the standards of Section 7702, your policy has to pass one of two tests. CVAT, or what we also call cash value accumulation test. This test indicates that there has to be a gap, or what we call a minimum corridor, between the amount of cash value that accumulates inside the policy relative to the size of that death benefit. If your cash value were to exceed or spill into that corridor, meaning it's getting closer to the size of the death benefit, you're going to create what is called a MEC, a modified endowment contract, which basically means the government and the IRS are now going to say your life insurance policy is no longer being used for life insurance, it's being used as an investment, and all of the interest you earned inside of that policy is now taxable, which basically defeats the whole purpose of building wealth inside of life insurance in the first place. The other test is called GPT, or what we call Guideline Premium Test. This test put a limit on the amount of money that can be contributed into a life insurance policy relative to the size of the death benefit. Previously, there was no limit. You could put in as much money as you wanted into a policy, didn't matter based on the size of the death benefit. Now, the more life insurance you get, the more money you can put in that policy per year. The less life insurance you get, the less money you can put in per year. So this test really puts some strict rules around contributions into these plans. These two tests alone really put a damper on the money laundering industry because now in order to be considered life insurance, your policy has to follow some guidelines. So these really were created to help protect the insured or the individual and ensure that the life insurance was being used for its original intent, which was life insurance. The government created 3 separate laws or acts to help govern these tests. TEFRA came out in 1982 with the intent to govern CVAT and GPT. Then they built upon that with DEFRA in 1984, which basically gave some rules on accessibility of your money out of these policies. Then TAMRA came out in 1988 that basically governed the MEC, or what we now call a modified endowment contract, which basically ensures that the life insurance policy isn't being used as a tax shelter and a way to build wealth tax-free. These laws really do govern and place stricter guidelines on life insurance policies to ensure that it's being used again for its original intent. These regulations culminated in the development of Section 72E, which outlines how the policy's cash value is going to get taxed. And hint, you have access to your cash value tax-free if you loan it to yourself. If you withdraw it, that's a different story. And as for the death benefit, Section 101A outlined that the death benefit of a life insurance policy would remain tax-free when inherited by beneficiaries as long as the policy was deemed and considered a real, true life insurance policy. So what does all of this mean? Life insurance was created as this simple product to protect families after somebody's passing. And over the years, as people got more creative with their investment strategies, the government had to intervene and regulate to ensure that life insurance was still being used for its original intent, which was to protect widows and children. These regulations really helped protect consumers and ensure that life insurance remained a powerful tool for financial planning. If you're sitting there and you're wanting more, you still want to dive into how life insurance can build wealth tax-free, don't worry, I've linked 2 videos here that will talk to you more about how that concept works. Just make sure that you subscribe so you don't miss another great video teaching you what the wealthy do with their money, and I'll see you back here next week on YouTube.